Hi, Chris Duff over at Serious Land Capital Vacant Land Funding Partner. Today, wanted to comment a bit on the issue of trying to compress margin for higher absolute value deals, just assuming that you can make more significant dollars in an absolute sense upon the sale. Yes, in principle, on paper, this is true. We get a number of deals sent our way, and usually above 100K or so purchase price. A lot of folks be thinking, okay, we can keep a more compressed margin to work with just because, okay, I'm going to make the same amount of dollars, if not more, for lower relative margin compared to doing a, lower absolute value deal. So again, we see that all the time in practice. It's a risky proposition at best. Again, we can speak from experience and mistakes we have made along the way by following that principle in the past here. Just to jump ahead, based on our experience, if anything, we're even more conservative when it comes to higher absolute value deals, north of 120-ish to 150,000 buy price in terms of relative margin that we'll look for on the deal, regardless of that possible absolute value that we could potentially work with there. So that's just something to keep in mind. And I know a lot of folks, you might think, could set up a novation contract for a property, a wholesale deal, which great, that's fine, because then you can just have obviously less relative margin on a deal and still earn your absolute dollars that you're looking for with smaller margin. But I know, again, a lot of folks will come to us as an equity funder and expect, okay, I even saw one earlier that was a 200K buy and maybe sell for, I think it was 245, 250, like extremely tight margin. And that's, even if you did exit for that amount and, in a quick fashion, take into account closing costs, the buy and sell side, conservatively estimate it's going to cost like 3,000 to 4,000. And, between a 6 to, at the high end, 10% of commission for a deal like that. And all of a sudden you have almost no margin on a deal, compared to the, inherent opportunity cost as well as capital risk and market risk associated with the property. And again, generally in our experience, the higher value the deal, the longer the time on market, and obviously just higher capital risk. So, less opportunity to potentially turn over the same dollar that goes into that deal if the larger deal is not as fast moving. So those are always going into our calculations when considering these properties. So, we rarely go beyond roughly 60% conservative market value in terms of the purchase price that we might consider for a property. For those higher value deals, again, north of like 100K buys, usually it's going to have to be quite conservative at that roughly 50% of conservative market value, just given our experience getting caught on the bad side of deals and watching, margin quickly diminish. And those are the ones that'll keep you up at night. Like whenever there's dispo issues in the business, those are always the ones that make me stress out more than anything else going on. So that is just something that we've learned in our experience, and I'm just sharing this to anybody who would consider funding from us or from other equity funders. Like I know every other funder will have their own criteria, but roughly going to be thinking similarly about that. And even if you weren't looking to utilize outside funding, again, I would be extremely cautious about that. opportunity risk and possible high risk play of trying to squeeze out more absolute dollars with a tight relative margin deal. It's unless the market is like very obvious, which oftentimes for those higher priced properties it's not. You're going to have less cookie cutter situations, like a lot of subdivisions or infill lots might be. I mean, occasionally you'll have like some super high value infill lots or pretty standardized property characteristics, more cookie cutter, but those are few and far between. Very, very rarely, because oftentimes those sellers are going to be more sophisticated, like to get an oceanfront or really nice lakefront property, super nice HOA neighborhood, gated community. It's very rare that you're going to just have a seller accept a much lower price in relation to conservative market value that they just rarely come up. So more often than not, those higher priced properties tend to be in more rural areas where there can be just higher risk on assuming the true price per acre, just the overall price of the parcel that you're going to be able to exit. Again, we speak from experience, both from infill lot side as well as rural, and can certainly share more about those. Bottom line to summarize, whenever you're looking for high-priced properties, especially if you're looking for equity funding, be more conservative on the margin than you would expect. And that's regardless of whether you're searching for funding or not. Just be extra cautious about those higher-priced properties. Try to build in more margin. Even more so than properties that are below 100K. Like, it sounds counterintuitive. You think, I have a 200K buy, 280 to 300 exit. Even net of exit costs, great, but you're only looking at the on paper value, when in reality, when you get into the market, anything can happen, and you don't want to be sitting on a downside case or actively losing money because something happened, and or you just did not assess the market as conservatively as you should have. Or again, even if your work was perfect, things can happen, and you always want to bake in the downside risk scenario to account for those unknown unknowns. So keep all of that in mind. Again, if you're looking for funding, seriousland.capital, zero cost review of your land deals at Land Daily Diligence Facebook group, and landpricer.ai for the most simple and accurate way to price land. Looking forward to the next one. Take care, everybody. Bye.